Hello everyone, my name is CMA. Welcome back to CMA modules. Today we will be recording a video lecture on subject Financial Accounting Module 1. In our previous lecture, we had completed different types of frameworks. We went for different types of frameworks. There are four frameworks of accounting. We went for a thorough study of what are four frameworks. We also went for introduction of concepts and conventions. So what is concept, what is conventions, what are principles? So basically, if I want to do accounting, I have to follow rules and regulations. Without obeying rules and regulations, I'll not be able to do my accounting. Okay, so here this chapter, module 1.2, is giving us a brief idea as to how to go for accounting, how to do our accounting. Okay, so the responsibility of accounting is to provide financial information to the users of accounting information. So what is the responsibility of accounting? Whosoever does the accounting, his responsibility is to provide financial information to the users. Okay, my responsibility, suppose I'm going for accounts. So I need to give financial information to the users, how my company is performing. Based on that, I'll attract customers, I'll attract employees, I'll attract investors. For this purpose, it keeps records of various transactions in the books of accounts. I paid bill for refreshment, 1,000 rupees, I'll have to record. I paid bill for printing and stationery, I'll have to record. For this purpose, it keeps records of various transactions in its books of accounts. The practice of record keeping may be practiced differently by different organizations. In order to ensure uniformity and consistency in record keeping, accounting profession has developed rules, conventions, standards, and procedures which are generally accepted. So in order to ensure uniformity, I want uniformity. Suppose I am preparing accounts for Reliance company and my friend she is preparing accounts for Tata. So we both, suppose the investor or employee who wants to join, okay, he wants to compare Reliance as well as Tata. So we both have to prepare our accounts obeying certain rules and regulations, certain principles. There should be uniformity in both of us accounts. Then only she'll be able to, the new employee or the investor who wants to invest, he'll be able to compare and then accordingly he'll be taking decisions. So uniformity, consistency, such type of things is must. Without that, I cannot perform. And keeping the accounting profession has developed rules, conventions, standards, and procedures which are generally accepted and universally practiced. They are generally accepted and universally practiced. I will obey and you will not obey. It is not like that. If I am debiting expenses, even you will have to debit expenses. This common set of rules, conventions, standards, and procedures is referred to as generally accepted accounting principles. It is obeyed by everyone, followed by everyone. I will only follow and you will not follow. No, it is not like that. Everyone is following. The generally accepted accounting principles indicates how to report economic events and thus used by organizations in drafting their financial statements. So these principles, what they do is they report economic events and thus used by organizations in drafting the financial statements. They are to be followed by organizations so that the users of accounting information have an optimum level of consistency in financial statements they use when analyzing companies for investment purposes. Such accounting principles have been developed from research, accepted accounting practices, and pronouncements of regulators. In India, financial statements are prepared on the basis of accounting standards issued by Institute of Chartered Accountants of India. So we have Institute of Chartered Accountant of India. What institute will do? Will on a timely basis, institute will upload notifications, circulars, will give accounting policies, practices, how we are supposed to follow. Same way, our Institute of Cost and Works Accountants of India, what institute will give us policies, rules, regulations, circulars, notifications for how to perform costing, cost accounting, cost auditing. Okay. Concept of accounting principles, accounting concepts and conventions. So what are accounting principles? They are rules, basic rules. Debit means debit, credit means credit. Accounting principles are basic rules which act as a primary standard for recording business transactions and maintaining books of accounts. They provide standards for scientific accounting practices and procedures. They guide as to how the transactions are to be recorded and reported. So we have accounting principles. Accounting principles are basic rules which act as primary standard for recording business transactions. They are basic rules for recording business transactions and maintaining books of accounts. They are basic rules for recording transaction. Recording is different and maintaining books of accounts is different. I'll record today I paid 1,000 rupees to vegetable vendor. I'll record and tomorrow I'll throw away that paper. So that is not maintaining books of accounts. Recording and maintaining books of accounts and preserving them. They provide standards for scientific accounting practices and procedures. They guide as to how the transactions are to be recorded and reported. They assure uniformity and understandability. Accounting principles are accepted as such if they happen to be objective, unusable in practical situation, reliable, feasible, comprehensible to those with a basic knowledge of accounting and finance. Accounting principles can be split into accounting concepts and accounting conventions. So, what are accounting concepts? They refer to assumptions and conditions that define the parameters and constraints within which the accounting operates. They lay down the foundation for accounting principles and ensure recording of financial facts on sound basis and legal and logical considerations. The common accounting concepts are entity concept, going concern concept, periodicity concept. Okay, before going in detail, what is accounting concepts? They refer to assumptions and conditions. Accounting principles, they are basic rules. Accounting concepts, they are assumptions and conditions that define parameters and constraints within which the accounting operates. They lay down the foundation for accounting principles and ensure recording of financial facts on sound basis and logical consideration. The common accounting concepts are entity concept, going concern concept, periodicity concept, money measurement concept, accrual concept, dual aspect concept, matching concept, realization concept, cost concept. They are nothing but they are assumptions. I'm assuming that my friend will come to my house today. I have not communicated with my friend. I don't know whether she is going to come or no, but I'm assuming that by 7 o'clock today in the evening she'll come to my house. That's assumptions. So assumptions here means what? Accounting concepts, assumptions and conditions that define parameters and constraints. So a basic distinction between principle and concept. Principles are basic rules, and accounting concepts, they are assumptions and conditions. Accounting concepts are assumptions and conditions. We have entity concept, we have going concern concept, we have periodicity concept, money measurement concept, accrual concept, dual aspect concept, matching concept, realization concept, and post concept. Now let us try to understand one by one all the concepts. Before that, let us go for accounting conventions. What are conventions? They are customs, methods. ऐसे ही होता है. We do it this way. By first of the month, we send our Excel files to our employers, to our managers. ऐसे ही होता है. Custom है वो. ऐसे ही ये method है हमारा. So accounting conventions are customs, methods, procedures, or guidelines associated with practical applications. So 3 points: accounting principles, accounting concepts, accounting conventions. What are principles? Principles are basic rules. What are concepts? Concepts are nothing but they are assumptions or conditions. Assumptions and or nahi, assumptions and conditions. Accounting conventions, they are customs, methods, procedures, or guidelines associated with the practical applications of accounting principles. They are widely accepted and are common practice which are used as a guideline when recording transactions. Accounting conventions are a necessary part of accounting profession since they result in transactions being recorded in same way by multiple organizations. This allows for reliable comparison of financial facts and figures. However, accounting conventions may change over a period of time, thus reflecting shifts in general opinion or practice of dealing with transactions. The different accounting conventions are convention of conservatism, convention of consistency, convention of materiality, and convention of full disclosure. So we have concepts. There are 6, 7, 8, 9 concepts and four conventions. So let us one by one try to study what is accounting concept and later on we'll go for accounting conventions. So entity concept. Me and my business are separate. Me and my business are distinct person. If my business dies, I am not, matlab, I'll also not die. It is not like that. As per this concept, an organization is treated as distinct and separate from persons who own or manage it. In other words, this concept assumes that organization and business owners are two independent entities. As per this concept, organization is treated as distinct and separate. They are treated as distinct and separate from persons who own or manage it. Me and my business are distinct, they are separate. In other words, this concept assumes that organization and business owners are two independent entities. Hence, personal transactions of its owners is different from transactions of the organization. So, my personal transaction, paying insurance premium of mine, that is different. Insurance premium of my firm, that is different. So, personal transactions and transactions related to organizations, they are two different transactions. Application of this concept enables recording of transactions between the entity and its owners or other stakeholders. The entity concept requires that all the transactions are to be viewed, interpreted, and recorded from organization's point of view. For example, if the owner pays his personal expenses from the business cash, these transactions can be recorded in the books of business entity. These transactions will take the cash out of business and also reduce the obligation of the business towards the owner. That is entity concept. So what is entity concept? Me and my business are treated as distinct person. They are different. They are separate. Then going concern concept. Salo sal my business will go on. Mr. Dhirubhai Ambani is not there, but Reliance is there. After Mukesh Ambani, still Reliance will be there. The basic assumption of this concept is that an organization is assumed to continue to exist for an indefinite period of time. Okay, after this project, now I'll wind up. I'll close my business. I'll close my company. Okay, after this year, no, 2024, I'll close my year, my company. No, it is not like that. I'm assuming that my company will go on forever. Going concern concept, the basic assumption of this concept is that an organization is assumed to continue to exist for an indefinite period of time. This simply means that every concern has continuity of life unless there is good evidence to the contrary. The accountant assumes that an organization is a going concern. This concept enables the accountant to carry forward the values of assets and liabilities from one accounting period to the other without asking the question about usefulness and worth of the asset and recoverability of the receivables. The going concern concept forms the basis for preparation of balance sheet of an organization. So we have entity concept, we have going concern concept. Then we have accounting period concept. Accounting period concept assumes that and assumes indefinite life of an organization and can be split into smaller periods of equal duration. We have accounting period concept. What is accounting period concept? Accounting period concept assumes that indefinite life of an organization can be split into smaller periods of equal duration. Due to this concept, the operating results are ascertained for a specific period. Financial position is reflected at regular intervals. Then we have money measurement concept. What is money measurement concept? Any event which can be expressed in terms of money is always recorded in the books of accounts. I gifted 50,000 rupees to my friend on account of her birthday. I charged 50,000 rupees to my friend for teaching her. So, two different things. Recorded, anything recorded in money, any transaction which is expressed, I can express in terms of money, that will be recorded in my books of accounts. Advantage of this concept is that different types of transactions could be recorded as homogeneous entities with entries with money as common denominator. A business may own rupees 3 lakh cash, 1500 kgs of raw materials, 10 vehicles, 3 computers, etc. Unless each of this is expressed in terms of money, assets owned by business cannot ascertain. When expressed in common measure of money, transactions could be added or subtracted to find out combined effect. However, the limitation of this concept is that only the absolute value of money is considered, whereas the real value may fluctuate from time to time due to inflation, exchange rate changes, etc. So this is related to money measurement concept. Money measurement concept means anything recorded in money. Anything which I can express in terms of money, I have to. The denominator, common denominator is money. Then in that case, I have to record it in the books of accounts. That's money measurement concept. Accrual concept. Today a student came and he said, okay, I'll pay you 10,000 rupees as fees. I will pay you. But he took service and went, but he has not paid that. That's accrual on credit basis. This concept is based on recognition of both cash and credit transactions. In case of cash transactions, owner's equity is instantly affected as cash either is received or paid. He paid 10,000, loaned from me and went. That's cash transaction. But what is credit transactions? He is not paying me immediately. However, mere obligation towards or by organization is created when credit transaction exists. Revenues are not the same as cash receipts and expenses are not same as cash paid during the year. So that is what accrual concept. So accrual concept means when credit transaction exists, revenues are not same as cash receipts and expenses are not same as cash paid during the year. Dual aspect concept. Dual aspect concept means assumes that every transaction recorded in the books of accounts is based on two aspects, debit and credit. Every debit will have a credit. This concept provides basis for recording business transactions in the books of accounts. This implies that transactions that is recorded affects two or more accounts on their respective opposite sides. Hence, transactions should be recorded in at least two accounts. For example, goods purchased in cash have two aspects, such as paying cash and receiving goods. So every transactions have two aspects, debit and credit. A quick read till here. So what we learned, entity concept. Entity concept is me and my business are treated as different. They are separate. Then going concern concept, it is assumed that my business will go on forever for an indefinite period of time. There is no closure in near future. Accounting period concept, it is divided in equal periods, say quarterly, half yearly or yearly, to record my transactions, to ascertain my transactions at regular intervals. Money measurement concept, transactions are recorded in terms of money. Okay, suppose I have gold, but gold of how, matlab, what is the value, what is the worth of that gold? 3 lakh rupees. Then that 3 lakh rupees will be recorded in the books of accounts. So that is money measurement concept. Accrual concept, cash transactions are recorded, recognized immediately, but at the same time, you are supposed to recognize and record your credit transactions also. Accrual concept. Okay. Then you have dual aspect concept. Every debit and every credit. Every debit has corresponding credit. There are two aspects to every transactions. Okay. Then we'll go for matching concept. This concept states that revenue and expenses must be recorded at the same time at which they are incurred. In general, revenues earned should be matched with expenses incurred during the accounting period. For application of this concept, several adjustments are made for prepaid expenses, accrued incomes, etc. The operating results of an accounting period can be measured only when incomes are compared with related expenses incurred. So that is related to matching concept. What is matching concept? This concept states that revenues and expenses must be recorded at the same time at which they are incurred. Okay, both. Now I'll record only revenue. Chalo, let's record income. What about expenses? You have to record your expenses also. For earning 100 rupees, I incurred 60 rupees expenses. So I have to record 100 rupees and 60 rupees both. This concept states that revenue and expenses must be recorded at the same time at which they are incurred. In general, revenue earned should be matched with expenses incurred during accounting period. For application of this concept, several adjustments are made for prepaid expenses, accrued incomes, etc. Operating results of an accounting period can be measured only when incomes are compared with related expenses incurred. Realization concept. The concept of realization talks about how much of revenue should be recognized in the books of accounts. It says amount should be recognized only to the tune of which it is certainly realizable. Thus, mere getting an order from the customer won't make it eligible to be recognized as revenue. So, concept of realization talks about how much of revenue should be recognized in the books of accounts. How much of revenue? Okay. So, I'll talk to a client and I'll tell him, okay, I'll do your work. but doing is important and converting that work into money is important. The reasonable certainty of realizing the money will come only when the goods ordered are actually supplied to the customer and he is billed. This concept ensures that any income which is unearned or unrealized will not be considered as revenue. Cost concept. The cost concept states all the business assets should be written down in the books of accounts at the cost incurred for their acquisition, including any capital cost incurred in relation to installation. The assets are not to be recorded at their market price. For example, packing machine was purchased by Bharat Limited for rupees 40 lakhs. An amount of 30,000 was spent on transporting the machine to the factory site, and further rupees 20,000 was additionally spent on its installation. So cost concept. Whatever you have cost related to your business, you need to record them in your books of accounts. A quick read. We'll wait for a few minutes, then we'll go for accounting conventions. So what we studied related to accounting conventions, what are conventions? Conventions are nothing but they are methods, they are procedures, practices, guidelines. We perform our work this way. Okay, so they are conventions. So let us check what points are there under conventions. Conventions of conservatism. Convention of conservatism essentially assumes an uncertain future and as such advocates providing for all possible losses but never for possible future gains. As such, application of this convention would always result in understatement of income, profits, and thus resources. So we have convention of conservatism. So this convention of conservatism essentially assumes an uncertain future and as such advocates providing for all possible losses but never for possible future gains. Conventions of consistency. What is convention of consistency? On a daily basis, I'll keep on recording, I'll keep on using same thing. For example, depreciation. Today I'll record on SLM, next year WDV, SLM, WDV. No, I cannot hop this way. I cannot change this way. It should be consistent. Okay, this convention advocates continuous observation and application of rules and practices of accounting. The uniformity and consistency of accounting rules is vital to profit and loss calculations as well as comparisons of company performance. Frequent changes in the treatment of accounts would result in inconsistency and hence make the accounting information less reliable. It would result in making accounting information truthful, accurate, and complete. So we have convention of consistency. This convention advocates continuous observation and application. This convention advocates continuous observation and application of rules and practices. It advocates what? Continuous observations and applications of rules and practices of accounting. Uniformity and consistency of accounting rules is vital to profit and loss calculations as well as comparisons of company performance. Vital means important. Frequent changes in the treatment of accounts would result in inconsistency and hence make the accounts information less reliable. It would result in making accounting information truthful, accurate, and complete. Then we have convention of materiality. Convention of materiality advocates the recording and reflection of all material facts in the accounting records and elimination of insignificant information. So suppose there are few transactions which are not relevant. Materiality means what? Relevant. Whatever is relevant, whatever is important that you record. Whatever is irrelevant, not important, you don't record. You remove that. So convention of materiality, convention of conservatism, we advocate all losses. We make provisions for losses, but we don't make provisions for profits. That is convention of conservatism. Convention of consistency. On a regular basis, we follow certain rules, regulations, procedures to gain consistency. Convention of materiality. Convention of materiality advocates whatever is material that we record, whatever is not material that we don't record. Then we have convention of full disclosure. This convention advocates full disclosure of material information. कुछ भी मत छुपाओ. Disclose everything. whether favorable or otherwise, in the accounting statement of business enterprise. This convention requires that all accounting statements must be prepared honestly. The convention of disclosure holds greater importance in the case of businesses where the ownership is separate from the management. Accounting principle, concepts, and conventions are very, very important, vital to the accounting profession, since they bring about uniformity in the process of recording transactions. Such uniformity makes it possible to reliably compare the financial results, financial positions, and cash flows of different organizations and also over different periods. These thus go a long way in helping to standardize the financial reporting process. So, principles, concepts, and conventions are very, very important. They are important for preparing our accounts. They help us to standardize our process, okay, reporting process, which helps us to attract investors, good employees, good customers. We'll get good suppliers also. So we can go for, we can attract good stakeholders if we follow accounting principles, concepts, and conventions, and we prepare our accounts. I hope you like this video lecture. Thank you.